Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. She is an oil and natural gas expert. She's been a petroleum engineer for many years at Chevron, Hess Oil, and Schlumberger. Christine Guerrero, thank you for joining me again.
Yeah, and thanks for having me back on. I didn't intend to be here until December, so this mid-year revisit is different, but I think it's also necessary.
So we're recording this interview on Friday, April 5th, 2024. We've had a substantial rally in West Texas Intermediate crude oil prices. They're up to around $87 a barrel. Brent crude's above 90 at just under 91. U.S. natural gas prices are still very, very low at below $1.80. I want to get your thoughts, though, because you've been tweeting about this a lot lately, and so is Josh Young, my friend Josh Young, oil hedge fund manager at Bison Interests, about the Energy Information Agency. These estimates, it almost looks as bad as the jobs reports estimates being revised. Can you talk about how badly these estimates for the EIA have been off and why?
Okay, so the most important thing for everyone to, get in their head before we start talking about these numbers is what is the difference between the weekly EIA estimate and the monthly information that gets submitted a few months later. So on the weekly reporting that the EIA does, that takes into account voluntary reporting by oil and gas producers. So I don't know what percentage of voluntary reports they get. Maybe it's 25% of operators, maybe it's 50% of operators, but whatever they don't get, they're using their own assumptions and estimations in producing that number that they're giving the public on a weekly basis. That makes that everyone's laser focused on to figure out whether or not we're growing or we're shrinking. And then, like I said, a few months later, then everyone's required to physically report what their production was. And when all that information gets in, then EIA issues their monthly report, and we find out definitively what it was. So last week was when we got the number for January production for the U.S., the definitive number. And essentially what it told us was that oil production was actually 760,000 barrels per day, less than what everyone thought. And because of that massive drop in production, like we effectively wiped out almost all of our production growth from 2023. And here's kind of where it gets extra interesting and extra fuzzy, because seasonally, every winter production declines a little bit. It's expected. Everything kind of slows down in the oil field, over the holiday season. So that, some crews stay working, but other crews go home. And then also you'll have weather delays. Last year or this past winter, especially in January, we had a pretty mild winter. Maybe we had a week or two of actual winter, but for the most part, it was relatively mild, which is another reason why we have really low gas prices right now, which I'll talk about later. But but just kind of keep that in your head. These different push and pulls for what is creating an impact on the uplift or the decline of the nationwide oil production. So anyway, again, like seeing that big of a draw, it was huge. Like I looked back on the history of U.S. oil and gas production, and I had to go back 49 years in order to find an oil drop percentage-wise that was as big as what we saw in January from the previous December. And I actually kind of got into this a little bit with someone from Wood Mackenzie, because he was like, oh, you're being too hard on those numbers. We had the same situation occur in February during Winter Storm Uri. And I was just like, hey, like, why are we comparing Winter Storm Uri to January of this year for our mild winter? Because during Winter Storm Uri, the reason that the impact was so bad on production then was because ERCOT contacted a lot of the oil and gas companies in Texas and told them to turn off their electricity, which effectively turned off their pumps on a lot of these low volume, low pressure wells. And that's what allowed their wells to freeze over. Like nothing like that happened this year. and so I'm of the mindset that no way this 760,000 barrels was lost purely because of the winter effect of a 1 or 2 week winter event that might have limited water being moved between the different wells and crews doing their thing. It just didn't add up. But what does make sense to me is again, it's like we've had this transition from conventional oil production within the U.S. to being dominated by short cycle shale production. And these shale plays, they're not new. They are legacy plays now. They are mature plays. We have been producing these shale fields for 15 to 20 years. And over time within an oil basin, this happens whether it's a shale basin or whether it's a conventional basin. Like over time, the wells get more gassy and you tend to get a lower recovery of oil per each well drilled. And you get a higher gas oil ratio. And we see that occurring year over year within the Permian Basin and within the other basins within the U.S. I mean, even the best operators out there, with the largest percentage of tier 1 acreage left, still, if you look at their numbers from 2020 to 2021, and then 2021 to 2022, and then 2022 to 2023, you see these wells, their production, the quality of their production starting to roll over. So what a lot of these operators have done in order to try to continue to make their wells be economic is they've redesigned the well to have a longer lateral, which basically means a longer exposure to the reservoir, and they put more frac packages within that well in order to basically be able to flow a larger volume of oil. And then these wells come on, and hopefully they reach their peak production rate within a few months, and then they exponentially decline for the rest of their life. But if these wells come on and don't meet their initial production target, they probably should have never been drilled because they're probably uneconomic. And also remember that last year, the price of oil dropped into the 60s like 5 or 6 times. But you don't just say from week to week, I'm going to drill and I'm going to turn on all these wells. Like you planned your activity a year before. So in 2022, these companies all planned what their activity was going to be for 2023, not foreseeing that the price of oil was going to decline as it did. And so they were on these growth paths for last year, which brought a huge amount of production into the US. I mean, their production last year exceeded everyone's expectations. It was crazy. And it was so crazy that it oversupplied the market. And, with that on top of the year that the SPR had been released into the market, and it was just so much that, like I said, last year you had all this oil price weakness, we had all this extra production, and the whole market just got spongy, and also with that sponginess, there were a lot of other things happening fundamentally in the background that the market wouldn't necessarily notice, like the higher gas content and the higher gas production, the associated gas coming from the Permian Basin. And so at the end of the year, there we're at, in September, we had that peak with the oil production, and then it kind of it slacked off a little bit, but it stayed really high through December, and also in December we're having a pretty warm winter. So we've got all this gas being produced with all of this added oil production, and that gas has got nowhere to go. It's filling up storage because we're not using it, because we don't have a high heating demand, within the US. And that continued to occur throughout the entire winter. And that's why natural gas prices, are so low as they are. And and most people, they're just focused on what the Henry Hub gas price is, because that's the price that everyone has access to on their different trading platforms, unless you're a special futures trader, and that's the price that's talked about in mainstream media. But what they don't get is that we actually have gas terminals like all over the US in these different fields. And those different terminals are supplying their gas to various markets, based on the demand in their region and how interconnected their pipes are and things like that. So you have different terminals within the US that might be making 2 or 3 times what the Henry Hub spot prices are. But if you look at what the Permian Basin, which is ramped up their natural gas production like more than anyone ever expected, they're actually producing so much natural gas that their pipelines are currently full. Wow. And because they're full, they have to pay someone to take their natural gas away. So the Waha hub in the Permian Basin, if you look at their spot price, it's been negative throughout much of March. And it's negative right now. It's like negative 31 cents today.
So it sounds like an investment opportunity for a pipeline company like Plains All American or ONEOK or Enbridge to go in there, build more pipeline capacity, and make a lot of money moving the natural gas to get a higher price.
So things like that are occurring. So there's 2 ways to boost capacity when you have a situation like this. If you have an existing pipeline, depending on what the pressure requirements are, you might be able to go put a compression system on the line, and you might be able to compress a lot of natural gas to fit more natural gas within that line. And that's occurring, but that is like a nominal uplift in the volume. It's not a huge uplift in the volume. And we are building another pipeline. I don't remember when it was started, but it's called the Matterhorn pipeline, and it's scheduled to be completed in Q3, probably the end of Q3, more so than the beginning of Q3. And when the Matterhorn comes online, it's going to basically flow the gas from the Permian Basin to the Gulf Coast shipping channel, and all these new LNG terminals that are being built are going to be there to receive the gas, to convert it into LNG, and then ship it to foreign markets. But it's April. It's not September, when this line is probably going to be going on, coming on. So the real question here for everyone is, so what's going to happen in the next 4 or 5 months within the Permian Basin? If let's say that summer demand gets here and natural gas would hopefully increase our natural gas requirement a little bit. So May, June, July, August, September, we should be seeing the energy requirements for natural gas creep up, and maybe that gives us some breathing room where we can extract more of that gas and get it down. But if the natural gas production stays oversupplied to the point that you can't add any more to the existing lines between now and August, September, we're probably in a situation where you cannot grow oil production out of the Permian, which is the biggest component of U.S. oil production. And that might actually mean that between now and September, October, you don't get any incremental oil from the U.S., no matter what the price is. Because when you don't have a pipeline to put your gas in, if you want to increase your oil production, there's only one thing that you could do, and that would be flare your natural gas into the atmosphere. And that is a situation that just is not acceptable. And on top of it not being acceptable, like let's say if a company thought, you know what, like no one's watching, I'm going to vent and I'm going to get my oil produced and like hopefully no one drives by or notices that I've got excessive flaring. Like let's say a company wanted to take that gamble. The reality is they really can no longer do that and not get caught, because in early March, when Elon launched the Falcon 9, I think that's what it's called, the last SpaceX flight that got launched, there was a satellite on that rocket called the Methane Sat, and it's Google technology, and it is in partnership with one of the. Hold on, I'm like trying to find my notes. The EPA is basically partnered with Google and some other organizations on this satellite, and so again, like launched March 4th, so just 1 month ago. I think by the 6th, it was already online, and this satellite is circling the Earth 15 times a day, and it is programmed to focus on all of the major oil and gas facilities around the world, and to capture their methane emissions and stream it back to different receivers all around the globe. And it's not live streamed to the public yet, but soon it will be. So there's like this convergence of things happening within oil and gas right now, that to where it's like, even if you wanted to be a bad player and try to boost your oil in order to capture some of these high prices, you're going to get publicly shamed and smacked down because you had no place to put your gas. And that's why I believe that we're not seeing a huge rebound in the rig activity and in the frac crew activity yet. So actually, every Friday we get the weekly rig count for these basins, and then the weekly frac crew count for these basins. And like, I think it only, bumped up. The rigs only bumped up by like 2, but that's not a big influencer on the near-term production as the frac crews and the frac spreads are. So the frac spreads week over week, we actually reduced the frac spreads by 3, and year over year, the frac spread count is down by 30. So what that tells me is, if I look back a year ago at what production was doing in the Permian Basin, if like whatever it was growing a year ago, we're most likely not physically able to grow that much today, because we don't have that many wells being completed. Like, I even went so far as to jump into the Texas Railroad Commission, and I started looking through their various permits. And a lot of times when a well is being drilled, they'll have a permit for flaring. And for the month of March last year, there were 220 new flaring permits issued. And then for this March, this last month, there was only 154 permits issued. So that's a 30% reduction potentially in the wells that are being drilled today than what were being drilled a year ago. And I promise you, we have not had any technology breakthrough that has allowed us to produce much more oil and gas with 30% less wells in the past year. Hasn't happened. So again, it's just like there's all these little key points of data that when you put them all together, you start to see, wow, like we truly are bottlenecked right now. We're bottlenecked because we didn't build ahead soon enough to meet our growth expectations. And whose fault that is, I mean, everybody can get around and point fingers and do whatever, but part of the problem is that you have hundreds, if not thousands, of producers within the Permian Basin, and they're not allowed to all get together and talk about what they're going to do. I mean, like that would be like disallowed. So everyone like they make their plans and they make assumptions about what everyone else is doing, but the real problem is in 22 they grew as hard as they could, and in 2023 they still had those plans in play, and they literally like bust through everyone's expectations for the basin in terms of production. And so in December, when the seasonality hit, they dialed down. And what we've seen is that they really haven't dialed back up again. And that's why I think we've seen already 760,000 barrels per day of oil lost. And I think that when I look at the numbers that kind of follow from February and March, and like I said, I don't have production numbers yet. Like I am not putting any faith into the weekly numbers, so I'm only looking at what the frac activity is, what the well completions are, and what the flaring permits are. And when I look at that for February and March, I think that U.S. oil production might still be falling. We might have lost another 500,000 barrels a day from January. I mean, like we won't know for another 2 months. In like 4 weeks, we'll know what the definitive February number was, and then it'll be another month before we get the March number. But at this point in time, wherever we are, it's probably as high as we're going to be until the third quarter.
Or the Fed cuts interest rates, because I mean, I think cost of capital and interest rates are playing a part as well. And then when these companies
it's not even about interest rates anymore, because what do they do with their gas?
There's nowhere to put it, like you said, with the pipelines to go get the higher price. So they're not going to lose money then on the gas. They're not going to produce then, you said.
Well, they either have to lose money on the gas or they have to flare it into the atmosphere. Is the government going to tell oil producers, forget about methane emissions? If you can't sell it, flare it. They're not going to do that.
And then with these acquisitions,
all the big companies in the Permian Basin, Exxon, Conoco, Chevron, like they have all been asked about this in their analyst meetings. So not things that you would necessarily hear publicly, but they've been asked about it, like, in their roundtables, and they have said, we will shut in production before we flare unnecessarily. And I think that's what we're seeing today.
Do you also think with the mergers and acquisitions, and there's been a lot of them the last 6 to 8 months, I think the estimates, if some of these deals do go through that are large for tens of billions, it's going to be $230 billion, that those acquisitions is going to slow production down further too?
No, I don't think it will. Because actually, a lot of these acquisitions, the companies that are buying these smaller companies, they have a more efficient well design than the company that they're acquiring. Like maybe not Exxon and Pioneer. I don't know if all those technical assumptions are going to play out, because Pioneer is an exceptional company already and their well production is very good. But like, for instance, if you look at the Apache and the Petroleum acquisition, Apache actually, their well performance is much better than Callan's. So if they start completing Callan's acreage the same way that they're completing their own acreage, if we assume that's like for like, then potentially there would be better well productivity from those wells than what has been seen in the past.
Okay, so are they going to increase production though, or they still have the natural gas problem that you just described?
Yeah, right now, no one can increase production.
And you said
So long as Waha is negative, you better believe no one can increase production. So if you want to know when oil production is going to go up, watch the Waha and see if it ever goes back above zero, because that means that it's starting to tighten up or starting to loosen up a little bit, and maybe they can feed more supply.
And it also sounds like there's investment opportunities for the pipeline companies there as well. But if I could summarize what you were talking about in great detail, by the way, over the last 25 minutes, you've basically described that in 2023, with these downward revisions for EIA for oil estimates, the 760,000 oil production drop, that there was no growth for 2023. Is that correct?
Well, what I'm saying is everything that occurred for the growth got wiped out over the course of 1 or 2 months, because shale wells decline so rapidly that if you're not increasing your rigs and increasing your frac spreads, you are effectively in decline. That's the problem with these wells. Like with the conventional well, it comes on and it has a slow, gradual decline. So like we've never had this again running on a treadmill, and in the case of these shale wells, the treadmill is slowly speeding up. You've got to run faster and faster, because year over year, and we see this in the EIA data and in the EIA reports when they come out. The amount of legacy production year over year that has to be replaced by new wells is increasing. So you effectively drill more reservoir, this year than you did last year, and bring that online, and in order to increase production.
It's the hamster wheel problem, as we were talking about on Twitter.
Yeah,
it sounds like
it's crazy. It's and like people don't get it, because unless you're again in the oil and gas realm and you really understand the decline curve of a conventional field versus a shale field, like what those decline curves look like if you study that, you'll get it.
Okay,
but people, the average person doesn't know that. They don't necessarily need to know that. But the issue is the U.S. is now dominated by short cycle shale wells, and the decline rate is phenomenal, to the point that if you slow down your activity, which again, we might see this by February, March. I mean, we've already lost 660,000, barrels per day. I think potentially we might lose another 500,000 before we find a bottom. I mean, effectively, we would have potentially lost more than 1 million barrels of oil per day because we simply slowed down for a few months.
So where do you think global oil production growth is going to come from? So for our listeners out there who are not American, don't work in the oil industry like you, Christine, since 2008, the financial crisis, I think the Permian Basin is responsible for around 85% of global oil production growth. It's a massive percentage of the total global oil production growth.
Yeah, it's the U.S. has dominated in terms of performance, for a decade. But this year was the first year that companies, you actually saw their business plans, and they were ramping up CapEx internationally more than they were ramping up CapEx in the U.S. And again, that's because the U.S. is mature. I mean, we're flattened, we're topped out in a number of ways right now. And so when you think about growth is going to come from South America. It's going to come from the Middle East. It's going to come from Southeast Asia. It's going to come from Africa. I mean, so once a month, the international rig count gets gets reported. And
sorry to interrupt you. Are you talking about deep water drilling, or are you talking about like shale fields
everything.
like Argentina?
I'm talking everything. I'm talking about offshore, onshore, shallow water, deep water, shale. I'm talking about everything because oil production, it's a global issue. It's a global commodity. It has to come from as many regions as it possibly can, because no one region can feel the needs of the entire world. The U.S. has really been feeding the system, like dominating it, in my mind, foolishly for too long.
Yeah, I agree. Without the Permian Basin oil production growth, there was almost no growth globally. I mean, like Argentina, for example, is talking about growing their shale oil fields by, I think, 500,000 barrels per day. That's large for Argentina, but for the global oil production growth, it's almost nothing.
Yeah, I mean, what people need to remember when they talk about Argentina is that the Vaca Muerta field, it's considered to be equivalent to the Eagleford in Texas, which, like, when you think about scale, and of course we all talk about the Permian because the Permian is the dominant basin within the U.S. The Vaca Muerta, I mean, Argentina's basin, it might only be 20 or 25% of what the Permian is. So really, if you think that we're going to use short cycle to try to replicate what the U.S. has done in all these regions, we need like 5 more Argentinas. But the other issue with short cycle is the sheer amount of materials and labor that's needed to bring online hundreds of thousands of wells that are low volume wells. That's why deep water really dominates in terms of the project rate of return, because you can do, with a dozen wells, what thousands of wells would do in a shale basin. And when you bring a deep water project on with your, few dozen wells, the plateau is going to be, a multi-year flat plateau. And then normally they'll do exploration around the field that they put their FPSO or their platform there for. And then in the outer years, they'll continue to tie back additional discoveries into their facility. So, like in the Gulf of Mexico, you hear a lot about single well tiebacks. So companies that will already have a facility in the Gulf of Mexico, they'll go drill an exploration prospect that's within reach, and it might only be 15 or 30 million barrel prospect, but they can drill that with one well, and then they can turn that well on, and they might only need that one well to deliver all those volumes.
If I could sum up deep water, I think we're going to enter a bull market for deep water drilling. You also have a lot of these older deep water offshore drill rigs. The older ones are being retired, so they're going to have to be replaced by more expensive ones. So I see like Transocean, those ones are going to be able to lease them out at higher rates, because I don't see oil production growth without deep water. That was not the case during the heights of the Permian Basin for almost a decade, but I honestly don't see oil production growth without deep water going forward.
Yeah, it's just like I said, it's going to be all hands on deck. There will be smaller producers that go into old shallow fields and bring on incremental production, But yeah, when you hear about the massive major capital projects that are a billion barrel fields that produce 200,000 barrels a day, those will be the deep water projects.
So for natural gas, do you expect then a bottom in the next 6 to 12 months? What are the opportunities there? Are low cost producers, are they hedged out, or do you think there's going to be bankruptcies?
Well, so most of the people who produce natural gas, a lot of them do have a pretty decent hedge book, but they're still going to have to pay transport cost along with these hedges. So for people who are really interested in this, I would say as these reports start flowing in, later on this month, and then pretty much next month is going to be nothing but earnings reports from these different companies. Like, pay special attention to their transportation cost and see whether or not the transportation cost increased quarter over quarter, because that could end up being the effect that we're seeing from you have to pay to get your gas taken away. And some companies, like some companies won't have all of their natural gas production hedged. They might only have half of it hedged or 50% of it hedged. So, so you're going to see, where the stuff that wasn't hedged is going to hurt them. I think there could end up being a lot of earning surprises occur in Q1. Because everyone is expecting these companies to grow, not to have declined, and they're not going to be expecting this potential burden that was laid on to them in March, where everything went negative.
So you're talking about oil production growth, or are you talking about companies that have a higher percentage of natural gas in their wells? Because wasn't there comments? Okay.
Both. We've lost 700,000 barrels per day of oil. That's spread out amongst a number of companies.
But some of these oil producers are lower cost, right? Don't they still have free cash flow? Are you saying that those numbers are not going to be as expected because of the percentage in natural gas production in the wells then?
I'm saying there will be some companies that miss their production targets.
So we're going to have, instead of earnings beats for some of these companies, we're going to have, they're going to miss earnings. So top and bottom line, there's going to be some substantial misses then, sounds like what you're predicting.
I mean, potentially.
That's interesting.
Like I said, I don't have the information to tell you whose production was safe and whose production was getting hammered. Like I haven't, it would probably take me another couple weeks, or I'd have to go, buy in, like there are a number of services that you can pay for that will actually give you the individual well information, but I don't pay for any of those services.
Do you think that's why some of these companies were so eager, the private shale drillers were so eager to cash out of the company and sell it to a larger independent or a major?
I mean, I think a lot of those producers were tired. I mean, it's been a hard life for oil and gas in general. So like, let's just talk about the history of the oil spot price. So, and I probably talked about this a little bit before, like on your show. So in 2008, like that was before shale really took off. And that was when the globe had, like they were in a supply squeeze. Like we were actively looking for more oil and gas reserves offshore, but we didn't have a sufficient number of rigs at the time. Like it looked like offshore drilling rig rates were going to hit $1 million a day.
Didn't we hit 147 Brent crude in 2007, right? And in
2008.
Okay.
Yeah, in 2008, it went up to 147. What caused it to tip over and crater was the financial crash. So the financial crash, tipped it over. Oil went down, maybe into the 40s, and in 2000, early 2009. And then by 2010, it had pretty much already rapidly recovered up to like $85 a barrel. And then from 2011 to 2014, oil was really range trading between $90 and $110 per barrel US dollars. If you inflation adjusted that range from 2011 to 2014, if we inflation adjusted that to today, it would be $124 to $152 per barrel. And we paid that for 4 years. And then that was when all of a sudden shale started booming. and shale oversupplied the market, and oil prices crashed in 2015. And then we had and just like today, like oil prices crashed last year, and the shale continued to grow. Like that already happened before. It happened from 2015 to 2020. So from 2015 to 2020, oil prices pretty much sucked. Like they were like $30 up to about $75 in a good year, like in 2018. But in 2016, it was like all the way down to like $30. And 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 like those years coming into the COVID crash, and then with the COVID crash in 2020, and then also with all the political speak and everything else going on, talking about oil prices, like they've really created this recency bias within the public, and then even within politicians, on what oil should be priced at. But we also need to remember that those years from 2015 to 2020, when we had these great cheap oil prices and everybody was happy, during those years, more than 500 U.S. oil and gas companies went bankrupt. Those prices are not sustainable for the industry. They bankrupt the industry, and over $300 billion in debt was filed in their bankruptcy proceedings. So yeah, we had those 5 or 6 years of cheap oil, and it was paid for with someone else's money. And if we look at $50 per barrel in 2015, which is what really kicked off this wave of bankruptcies, that would be $65 per barrel now. And that's a price that we basically hit 5 or 6 times last year. So knowing last year that oil was touching on a price that starts to bankrupt the industry, do you really think that oil companies were planning to massively increase their CapEx budgets this year and make oil flow?
Definitely
No.
not, especially with natural gas prices where they are too, because they need the revenue from natural gas, right? So
yeah, I mean, really, like I said, we're at this crossroads where it's just like politicians and the economy and everything has just been hammering on this industry so hard, and this industry has been trying to claw its way out, but then every time they see like a glimmer of hope on the horizon, oh, maybe oil is going to be $85 or $90 next year. They all get like ravenous, and then they turn around and overproduce, and then they crater the industry again. And that hurts the entire global industry. I mean, it's like a nightmare the way shale cannibalizes itself. But now
it's a
we
hamster
have these
wheel.
pipeline
Yeah, it's not efficient.
constraints.
It's a hamster
Yeah,
wheel.
so
It's not efficient.
yeah. But anyway, like I said, we've got these pipeline constraints now. So it kind of gives the rest of the world a chance to get busy ramping up their conventional production. And who knows? Like maybe by next year, all the wells in the Permian Basin are so gassy that we couldn't increase oil production if we had to, because it's no longer going to be an oil field. It's going to be an oily gas field.
So if I want to talk about what subsectors of the oil industry for investment opportunities, it sounds like the pipelines. If you can build a pipeline connecting that natural gas and get it at a higher price to liquefied natural gas exporters somewhere in the Gulf of Mexico, you're going to make a lot of money. That sounds like a good investment opportunity in the next year or two.
Yeah. So actually, like just within the last month, pretty much as soon as I realized what was going on with these pipelines, I immediately bought 2 pipeline companies. Both of those companies are paying more than an 8% dividend year over year. Both companies are increasing their capacity either by building new pipelines or by adding compression to their existing pipelines, which is high rate of return for the pipeline. And also, like if you look at the pipelines, their multiple undervalued versus the rest of the sector, and undervalued versus how they would have been valued, back in 2018 per se. So I do think that there are, a lot of good of pipelines. Like a pipeline company is not going to double. Like, you're not going to get rich fast. But for someone who just likes steady making money, like me, I mean, I live off of my investments now. I don't work as a petroleum engineer anymore. I work as a strategic advisor for a fund, and it's a startup. So most of my income is actually based off of my own investment performance. And I like divvy stocks because I'm using those dividends to pay my mortgage. So like I said, I do think that these pipeline companies are great investments here. Also, companies that are diversified. So I just told you, I don't believe the Permian Basin is growing, this year. So I would want to own producers in other basins outside of the Permian Basin, and then oil field service companies that are also diversified and are going to be picking up all of this global work that we're seeing. I mean, even the Gulf of Mexico is expected to grow its production over the next few years. So just because the Permian is flat doesn't mean that the other basins are. But the problem is the Permian is such a large component of our U.S. production that it's going to be hard to displace that lift that we saw in the past from these other smaller basins.
So it sounds like the larger companies and the independents, the mid-tier ones, they're not going to be investing in the future in shale oil like the Permian and others as much. And the CapEx is going to be invested into deep water wells or shale wells outside the United States then?
Well, the big companies like the Exxons, the Chevrons, the thing is they're just so huge that for them, if 20% of their portfolio is shale, it doesn't matter, because they've got so much growth in other areas that their shale can dial up 10% or it can dial down 10%. And like, as a company, it won't hurt their bottom line because they'll make up for it somewhere else.
Okay, so they're too big then, and then a specific play might not move the needle unless it's like what you were talking about in Guyana with that major discovery there for Hess Oil and Exxon Mobil.
Yeah, well, it's like 30 major discoveries now. They just keep finding more. So they have a decade's worth of fields already that they've discovered that they will continue to bring online and continue to produce. So it's a huge growth story that's occurring in Guyana, and this year Suriname should also, which is next door to Guyana. Total and Apache are probably going to FID their first project, which will be a 200,000, either 200 or 250,000 barrel per day FPSO. And in addition to that FPSO, right now, the government of Guyana and the government of Suriname, like, they are meeting with Exxon and Total and trying to figure out how to do like a joint gas project that would straddle the border more or less, to where both those governments could be feeding gas maybe into another LNG terminal down there. I mean, there's just like natural gas really is the fuel of the future. Like, everyone's hungry for it. The problem is the infrastructure just isn't really there yet to monetize on it. Like everyone believes that next year natural gas prices are recovered and will grow year over year. But 2024 looks like doom and gloom.
Well, so the futures curve price of natural gas prices a couple years out are still above 3, and then you have natural gas prices outside the United States are relatively higher. The problem is that gas that you described in the Permian sounds like it's trapped for now. So it has to be moved then to a port with pipeline and then liquefied natural gas with an export company like Cheniere Energy or one of the others, so that the company can it's basically an arbitrage to where they take that cheap natural gas in the Permian and then sell it at a higher price in Europe or Asia or an emerging market.
Well, yeah, and along with that comes with all the transport costs and the liquefaction cost. I mean, it's cheap here, but it gets more expensive the further you need to transport it.
Well, the problem is that a lot of these countries that want liquefied natural gas, they have oil and natural gas drilling bans domestically. So they're like, oh, we're going to build this super expensive liquefied natural gas import facility, and they have domestic drilling bans. So I guess that's good for American companies that are specialized in liquefied natural gas, but it's bad domestically because they're going to be importing it at a higher price.
Yeah, well, like I said, Europe pays a lot more than what we do, and then even within the U.S., if you look at what these different hubs are selling gas at, like if you look at the East Coast and the West Coast, you'll see that the prices that the gas is being sold out there, it's always higher than what the gas is being sold at, like in Oklahoma, in Texas, in Louisiana. And again, it's because of scarcity, in those regions. And you want to be the supplier, the only supplier that they can go to, because then you can charge a premium.
Well, those liquefied natural gas projects are very expensive too, but it sounds like once they're built, they can mint free cash flow. Cheniere Energy is doing very, very well. They have everything on long-term contracts.
Yeah, but like I said, it's not just them. Like the other thing that I think people need to stay focused on if they are going to be invested in LNG, and like just full disclosure, I don't have any LNG exposure right now. Like Qatar, Petroleum, and the Middle East and other regions outside the world that have tremendous oil and gas production capabilities and are more accessible to some of these hungry markets than the U.S. is. They're building their own infrastructure there. They're building, LNG export terminals, and they're even building pipelines. Like there's a pipeline being built from the Middle East to India. There's another pipeline being built from Africa up to Europe. And so LNG is a great I'm trying to come up with the word. It's like a great Band-Aid in lieu of a pipeline. But once a pipeline gets built, pipeline transportation will be cheaper than LNG transportation all day long.
Yeah, it makes a lot of sense.
The pipeline will always be the preferred transit versus LNG going on a ship somewhere.
Yeah, and you have to cool the gas to compress it, and then you have to you have to get it back to gas form. It's energy intensive, it's capital intensive. There's transportation costs, insurance costs to move the LNG tanker. It's just very, very expensive. But I mean, again, if these other countries didn't have domestic drilling bans, I mean, they could build those pipelines. They could drill domestically, build pipelines, and move the gas to their major cities. These countries just aren't doing that. They're announcing press releases. Oh, we're building this $20 billion or $30 billion liquefied natural gas import facility. I see those all the time now.
Well, yeah, but you also got to think there's a lot of knee-jerk reactions occurring because of the Russia-Ukraine war. Russia was feeding Europe natural gas. And then the war broke out, and all of their customers have been trying to get weaned off. And so they've scrambled to be able to receive LNG and do different things because they no longer have the natural gas being piped to them from Russia. So these are just the market dynamics that someone who's going to invest in that space needs to investigate and be comfortable with before they proceed.
So if I could summarize what you've been talking about for oil, you expect higher price floors for oil, that if oil drops to 60, 65 a barrel, I mean, it sounds like a lot of these shale oil drillers in the Permian It's not economic anymore, especially with natural gas prices where they are. And that's 30% or more of their revenue. So basically, then we're going to have higher price floors for oil. And a lot of the oil production growth is going to come from outside the United States or deep water. That seems to be the current way the market is set up.
Yeah, at least for 2024. Now for 2025, once the Matterhorn is online, in Q3 and probably fully operational by the end of the year, then they have the capacity in the Permian to potentially increase their oil output. But then you also got to start thinking, we just ran out of natural gas capacity. When are we going to run out of oil pipeline capacity? And potentially our oil pipeline capacity is already 80% full coming out of the Permian. And as you move from 80% capacity up to 90% capacity, you actually have to start paying more and more transit fees because you're fighting for more and more people for a space within that line. And no one is ever going to flow a line typically at 100%. So there's always the stated capacity and then there's the functional capacity. So like I said, I think we're probably at 80% capacity now, and transit cost as we increase oil production, whether somehow it happens in the next few months, but I don't think it's going to happen until Q3. So if we start increasing there, you should start to see the differentials on the transportation widening as they grow further. I mean, the basin has really just grown too fast for its own infrastructure. And this is the funny or not so funny thing. This situation that we're having right now with Waha negative in the Permian, it's happened before. It happened in 2018. It probably happened another time. Definitely it happened in 2018. But I ran across an article. Yeah, I ran across an article today, September 2018. Headline: Permian gas prices fall as production continues to grow.
Wasn't that when Chesapeake went bankrupt?
That thing, like I said, yeah, I mean, it could have been the same headline that should be splashed across the front new pages like that's occurring today. So you would think that these guys would learn to start looking at the basin constraints, in terms of their growth plans, but they can't coordinate with the thousands of other people there to make sure that everyone else isn't planning to grow just as aggressively as they are. And they outrun their capacity.
You just described so many different details. And if I could summarize, it sounds like the pipeline companies just have an incredible opportunity here in the next couple of years, and their cash flow dividend companies. Yeah, they're not going to, the share price might not double in a couple of years, but it's a really good cash flow business. You set up the pipeline and it's cash flow and it's a dividend company.
I mean, even if these companies just re-rate from, let me pull up one right now and see what its multiple is.
I think Enbridge is paying out over 7% dividend. You have Plains All American and One Oak. Those are the three major ones. I don't know if there's any other ones. I know they're planning pipeline capacity expansion. At least a couple of them are already in the Permian.
Yeah, I mean, I would look at, again, yeah, anybody located in the Permian. I mean, I'm not a financial advisor, but so do your own due diligence. Like I said, I'm a strategic advisor. But like Energy Transfer, that is a company that I own that I think is incredibly cheap compared to other companies. It's got an excellent dividend, like 8%. Valuation wise, it's cheaper, and it's building capacity, for Texas.
Are they C corporation now? Do they have a tradable C corporation, or are they only MLP with a K1?
Yeah, you're going to have to do the K1. Like K1s don't bother me. So yeah, I own multiple companies that are MLPs. And speaking of that, MLPX, that's another company that I like and I own, because I know that they are doing a lot of compression expansion on their existing infrastructures, which is high rate of return. Like I said, another 8% dividend, another one that is destined to re-rate. And even though it's a pipeline company, because it can add compression and grow, it's also a growth company. So,
but you expect higher price floors, though, it sounds like, because basically now you described that 60-65 is barely break even now. It sounds like we're going to be going higher in the future too, as the cost to drill these wells and just like the decline rate. Sounds like we're going to have higher price floors for oil. I don't know, 70, 75, 80. It's going to be higher going forward.
I mean, to me, it was shocking when oil fell into the 60s last year 5 or 6 times. Like I was like flabbergasted because I knew everything that had been gone through within the industry. I know the supply demand dynamics, and then the fact that our own government released so much oil that they cratered the industry. I mean, because basically that's what happened. Like it was the 200 and something barrels that got released from the SPR at the same time that the industry was trying to grow their production back to the pre-COVID number. Like I said, all these things just converged, and the global demand wasn't enough to support it. Like if China would have been strong last year, the industry would have been fine. Oil would have stayed in the 80s. Everybody would have been happy. But just like what we talked about in December, China wasn't strong last year. And the China weakness came into play. And that's what caused oil to fall from the 90s in like September back into the 60s again, was the China economic report. And something else that I recently found out. So here everyone's complaining about inflation, increasing prices, and everything else. In China, it's actually been the opposite. In China, it's their market has been incredibly recessionary, and so now you've got the auto makers and the farmers in China that are receiving so less money for their goods that they're in trouble. So, like I said, there's just so much stuff happening in the world right now. And if, like for someone who's heavily invested in the oil and gas space that like I am, you kind of have to have a line of sight on these different factors that, can upset the oil markets. And I mean, you really just start to see like what's happening in these, big global regions, and it's shocking. It's shocking. I mean, the economy globally is very fragile.
Yep, it's fragile with debt and credit and an oil price spike or natural gas price spike. So if there is an oil gasoline increase like massively, it's basically like the Federal Reserve Bank raising interest rates. It's very, very similar.
Yeah.
So if I could summarize what you said here, you expect that as we wrap up, that we could have oil production estimates continue to fall further, more than the 760,000. You think that it's not guaranteed, but there's a high probability it could continue to fall hundreds of thousands of barrels per day. A lot depends on the natural gas price. That infrastructure problem in the Permian has to be solved. And unless that's solved, there's not really an incentive right now for a lot of these Permian oil producers to continue to grow wells, because they don't know what to do with the natural gas until there's more pipeline capacity.
Yeah. I mean, they're handcuffed. Their hands are tied. They're capacity constrained. It doesn't matter if oil is $200 a barrel. The only way they could increase their oil production is to flare their natural gas, which they are not supposed to do.
Okay, so if we do get an oil price spike, sounds like Transocean and those deep water drillers then are going to take advantage of that. They're going to lock in higher rig rates, build new rigs. So that would be an opportunity then if we do get higher oil prices. Not the production growth you described until the pipeline problems are fixed. It's not going to happen in the Permian, though.
Yeah, but it can happen anywhere else. It can happen anywhere else. But the Permian is the biggest basin. So
you don't think there's also infrastructure issues? I think you described them in Argentina and elsewhere. I mean, it sounds like there's infrastructure problems in a lot of these new fields that are talking about large production growth increases too.
Well, I mean, what I'm saying about these other basins is they're small compared to the Permian. So it'll take like 10 of them to do what the Permian did last year. And basically what I'm saying is, like, at the beginning of the year, we might have thought we were producing 13 million barrels per day, but we might only be producing 12 million barrels per day, the US. And when you think about that potential production drop, it's huge. That's the amount of production per day that the SPR was dumping on the global market for an entire year. 1 million barrels per day.
And then that 1 million barrels per day has to be made up somewhere else. I think that's the most important point here, is if the Permian's not hitting the numbers, that oil production has to be made up somewhere else. Are the Saudis going to increase capacity, or this is going to be more deep water wells? It has to be made up somewhere else. Otherwise, the oil price is going to be moved higher to meet supply.
And so like, also right now, you're already seeing people pounding the table and rhetoric. People are already upset and mad that the Saudis haven't announced that they're going to grow their supply yet. But
I think they'll cut.
I think that's actually a little bit premature, because look at what is breaking out in the Middle East. I mean, war is breaking out in the Middle East everywhere. And what? You're upset that they don't want to put more cargoes on the Red Sea that would potentially be targeted by the Houthis? I mean,
yeah, I'm not a geopolitical expert. So right now in Israel and Iran, I mean, unless like Iran production comes offline, I don't see that affecting yet. But I mean, if the oil price went lower, I don't think the Saudis would increase production. I think they'd cut. I think the Saudis have made it clear that they need oil prices, and OPEC does too, at a certain minimum price floor, at least 75, 80 Brent. They can't have it.
No one is expecting them to cut. Everyone is expecting them to increase their supply. And like, I think I even said this the last time we talked, like, I feel like they will increase their supply this summer, and they've stated that a few times, I think, but people are upset that they're not increasing their supply now.
Didn't they extend the production cuts through May or June already? Yeah.
Through June. So they could easily say, okay, at their next meeting, they could easily say, yeah, we've decided to add 1 or 2 million barrels a day, in July. And now some people think that they have as many as 4 million barrels per day capacity. I don't think that they do. I've said that before. I said this last year. I think they have somewhere between 1 and 2 million barrels a day that they could add. Only time will tell. So again, we'll see. But the other component here is also what's happening with Russia, because now that Ukraine has bombed like 14% of their oil infrastructure, potentially they're capped out. And again, it takes all the the US, Russia, and Saudi, those are the top 3 global oil producers in the world.
Yep.
If the US is now capacity constrained, and if Russia is weakened because of infrastructure damage, and then also the fact that the sanctions, they can't access enough vessels, that only leaves Saudi. And Saudi might not have as much spare capacity as what a lot of people think. They don't have a history of producing at these high rates that everyone seems to think that they can. If you look back at their production history, they've never done it.
Well, also, they've water injected a lot of the Guar wells, so they've replaced the Guar wells with higher cost deep water offshore oil wells that are higher cost. I think they're like $40, $50 a barrel cost. Guar is declining pretty rapidly, from speaking with Josh Young.
I mean, Guar is a very old field. What, 40 or 50 years old? I mean, but they have more than just the Guar. I think everybody likes to talk about that field because it's their it's their oldest huge signature field, but they do have other fields beside that, but again, it's
they could bring on more production. I think it's higher cost, so I think it's like at least $10, $15, $20 a barrel higher. They've been adding deep water wells.
I think a lot of their offshore is focused to natural gas. But anyway, like I said, it's an interesting dynamic. And again, with everything happening in the Middle East right now, are they gonna load the Red Sea up with tankers? I don't know. I think there's a lot of hopium about what Saudi can do. And I think that everyone's going to blame Saudi if oil's $100 a barrel. But I could go back through my tweets. And when Russia got pounded by Ukrainian missiles, that was the first day that I said, we might hit $100 this summer. And sure enough, like now another couple weeks have gone by and we're what was it, 95 Brent today? So
I think that rally was
we're not
based on
even
the
in
estimates.
summer demand yet. Okay, people, we're not even in summer demand yet. It's still spring.
So you think then this rally in the oil price the last month or so, you think it's based on a combination with geopolitical risk premium in the Middle East, and then also what the market's repricing the demand estimates that were missed. The market saying, hey, that oil is not going to be increasing at the rate that we expected. So those are the two main factors you would say in the rally lately.
Fundamentally, oil should have been higher. The market has been pounding oil and ignoring the fundamentals. And it wasn't until the geopolitical risk escalated the situation that I think the market started to realize, like just today, this morning on CNBC, Jim Cramer, and I quote, he said, I don't know what the US producers are doing. Why aren't they increasing supply? Like, these people don't get it. They
I guess he
literally
thinks they
don't
could
get
just
it.
hit a button. They could just hit a button and supply comes along.
And I'm thinking to myself, man, I mean,
His big
you've
red
got your
clown
own
button.
telephone, you've got your own TV show, you're a commentator almost every morning on Market Watch, and you're on here recommending oil and gas companies, and you don't even know that the pipeline capacity is full. And that you're losing money right now to transport your national gas. Like the average person just doesn't get it. They haven't focused on oil and gas because they're too busy following the AI and the tech, growth
Those
path.
stocks, they're trying to
Like
get rich quick.
you
Day trading
literally,
now.
like it's, you need a team of people working full time to truly understand oil and gas. Like I've got, 25 years in the industry, and I'm still working like 200% of the time for me to understand the sector. Because it's just so big and there's just so much data, to look at. And so for people who think that they're going to dabble in this and they're going to get it, they are going to miss so much. And I think that's what's happening. There aren't a lot of people left who truly understand oil and gas dynamics.
As we wrap up here, Christine, want to get your opinion on ExxonMobil versus Chevron here, the right of first refusal for Hess Oil. Do you think that Chevron's going to end up with the assets, or do you think that ExxonMobil can block it? Because ExxonMobil has another deal, right? A $50 billion deal with Pioneer. Are they going to pay the exit fee, the $1 billion or $2 billion exit fee with Pioneer, walk away, and then just they're going to fight off Chevron and take the rest of the Guyana block from Hess Oil? What do you think? How do you think this is going to play out in the next year or two?
So Exxon has already said multiple times they are committed to Pioneer and they are going to close the Pioneer deal. So for them, having Pioneer and having Guyana in their portfolio is part of them having a balanced portfolio. And so in terms of Guyana, even though the Pioneer deal is a huge $60 billion deal, Exxon is just such a big, powerful company that they could actually do both deals. They could close on Pioneer, and they could afford to buy the 30% working interest in the stable block away from Chevron. because they won't have to buy all of Hess like what Chevron has offered. They simply need to come to an agreement on what price of the entire deal was allocated to the Stabler block, and then they need to pay more than that. Or, even if it's like $1 more, because if the right of first refusal holds up in court, and it's not just Exxon now, there's 3 players in that block. It's Exxon, Hess, and
China
CNOOC,
National,
the Chinese oil company. So CNOOC has actually joined the arbitration on Exxon's side because they also want a percentage of Hess's block. So if they win an arbitration, they can buy out the 30% from Hess for the amount of money in the Chevron deal that was allocated for the Stabler block, and then they can divide it between them. So Exxon will not be taking the full 30% from Hess. They might be taking 20, they might be taking 15, and then CNOOC will take the rest because they both want it.
Wait, ExxonMobil would take 15% of the 30% block, or
potentially, or maybe they'll take 20% of the 30%. But what I'm saying is they won't be taking the entire working interest of Hess. It will be divided between the 2 companies that are remaining in the joint venture.
And what options does Chevron have? Chevron they can't increase the bid. They can try to fight this in court. Is that really their only option?
Yeah, they could increase the bid to a price that Exxon and CNOOC doesn't want to overpay. But I will also say that Chevron is very fiscally disciplined. They do not like price wars. And we already saw this happen with the Anadarko situation. Chevron was going to buy Anadarko, and then Oxy came in and offered Anadarko more money. And then Chevron said, okay, give me my breakup fee. You can have it. And Oxy paid whatever they paid for Anadarko, and Chevron got $1 billion in their pocket to walk away. And this could end up being the same situation with the Chevron Hess deal. If Hess and Exxon and CNOOC in this arbitration, if Hess loses, then they would have to pay Chevron, I think it's 1.6 or $1.7 billion, because they will not be able to close the deal that they had with Chevron. So either way, Chevron wins. Either Chevron wins because they get the assets that they wanted for the price that they offered, or they win because they get paid a massive breakup fee and can go spend that money somewhere else. It was free.
Chevron's very shrewd with these deals. I mean, they bought a lot of cheap natural gas assets too over the last 5 to 10 years at a huge discount price too. They're pretty shrewd on these deals.
Like when it comes to mergers and acquisitions, like Chevron's brilliant. Like they are like sharks when there's blood in the water. I mean, like during the peak COVID crash, they were out picking up Noble and doing deals before anyone else did, because it goes back to the whole fortress balance sheet. Like they always have cash, and when there's blood in the water, like they go cherry pick like everything that they coveted for cheap. And I was actually really surprised to see them come to this merger with Hess. But I think John Hess, the owner, I mean, he's a little bit older, and I think that he just was at the point where he's like, you know what, I don't want to run this company anymore. I want to know that it has a future, and saw Chevron as a way that would kind of protect their legacy a little bit. But they didn't foresee that Exxon and CNOOC was gonna try to outlawyer them, and so now we're just gonna have to see how it plays out, because when Exxon and CNOOC said we're filing arbitration, I mean everybody was surprised, but Exxon has now put their legal expert, like they've literally said, we know what the contract says because we wrote it. So now that they've said that and it's been broadcast around the world, they better win. Otherwise, they're going to look weak and people are going to start challenging their contracts more. So we'll see, we'll see what happens. I mean, I know people at all companies, all three companies. Like I did not work for Exxon, but I worked for Chevron for 9 years and I worked for Hess for 3 years. So, I know people at two of these three companies, very well. And the Hess people seem very confident that they can close the deal with Chevron, and the Hess and the Exxon people seem very confident that they're going to win. So, I mean, I think, like, to me, this situation has actually been the fun part of being invested in oil and gas right now, because this Stabroek block in Guyana is like literally the most exciting, best field in the world. It's the newest, greatest thing, and records are being broken by Exxon year over year in terms of their exploration success and also in their speed of execution. And so now that we see this legal battle between all these big companies occurring, I mean, it's like Clash of the Titans, and it's almost exactly what should be occurring for an asset like this. And it's super fun. Like it's more fun talking about this legal battle than it is talking about pipeline constraints.
Especially if you're an investor in Hess, because it sounds like there could be a bidding war, but we'll see.
Well, like I said, based off of Chevron's history, I can't see Chevron getting into a bidding war. They'll take the 1.7 billion.
And I think over the last, 3 to 5 years, the Hess Oil shares have done very, very well. I mean, that stock was flat for 20 years. It didn't do very much. The long-term max chart, the stock was in a trading range. And then the last 3 to 5 years, I think based on the discovery in Guyana, the shares have just broken out.
Well, and that's also kind of the heart of the legal battle, is that so Chevron agreed to merge with Hess because as a loophole, as a workaround to the right of first refusal for the Stabroek block. But the fact is that the Stabroek block is the dominant value within
it's the gem of the asset
portfolio.
Yeah.
So anyone buying Hess is effectively buying Stabroek. And like that's what triggers this right of first refusal. So again, I mean, we'll see how it plays out. I think they will probably push the arbitration out long enough in order to let the Pioneer deal close, and then that arbitration will get prioritized. So I like they Chevron and Hess has already signaled that it's taken longer than what they thought, and I think that there's a little bit of legal stalling occurring right now on Exxon's side because they want to get the Pioneer deal closed. So I think they will, as soon as they get cleared by the FTC to close it, they'll close it, and then it'll be on to this arbitration.
You would think that if you were Chevron, you'd want ExxonMobil to close the deal with Pioneer, because then they'd spend more CapEx on all the fields that they just bought in the Permian Basin. That would make their ability to, maybe if Chevron raised the bid. But I guess you said that Chevron doesn't want to raise the bid.
I would be surprised if Chevron raised the bid, because again, they don't play those games. They are disciplined. They worked out their number. They agreed on a number. That's their number.
I admire that discipline. I mean, they bought a lot of great assets over the years for very, very cheap. Since the pandemic, the Noble Gas acquisition, Denbury. I mean, there was the one in Colorado, natural gas. So they've been doing smart acquisitions, not big ones, but smart ones.
Mm-hmm.
You are a true wealth of information today, Christine. I want to thank you so much for your time, for your oil and gas knowledge and expertise. If my listeners want to follow you on Twitter, how do they do so?
So I'm She Drills on Twitter. I definitely overpost about oil and gas. So if you go there, I mean, you'll find tons of graphs and charts and occasionally jokes and little tidbits that I put on there. And you're welcome to follow me.